Silver is currently trading close to $80 an ounce, and if you follow the financial media or YouTube commentary, you'll probably have seen a growing number of voices warning that a major silver crash is coming. Some commentators argue the rally was purely speculative. Others claim the price spike earlier in the cycle proves the market has become detached from reality, and that silver could soon fall back towards $50 or even lower. But before accepting that narrative, it's worth asking a very simple question. Does the actual structure of the silver market support the idea of a collapse? Because when you step away from the headlines and examine the underlying forces shaping the silver market in 2026, the picture looks very different from the panic narrative that is now circulating. In fact, what we may actually be seeing is something much more interesting. A market where short-term speculation is being flushed out while the physical fundamentals remain unusually tight. And that matters to you as a viewer for a simple reason. If the collapse narrative is wrong, then a large number of investors and observers may be misunderstanding what is actually happening in one of the most strategically important metals markets in the global economy. Welcome to Money and Power. If you're new to the channel, this is where we step back from the noise and look carefully at the forces shaping the global financial system. Commodities, currencies, geopolitics, and the structural shifts happening beneath the surface of markets. And if you find this kind of analysis useful, please consider liking the video and subscribing to the channel. It helps the algorithm understand that viewers want serious analysis rather than sensational headlines. And also, if you want the full weekly strategic briefing on gold, silver, oil, and the global monetary system, you can join us on Substack through the 2% Brief, where the deeper interpretation of these developments is published. And you can find a link to the 2% Brief in the description and comments section below. But let's return to silver, because the starting point for this discussion is the claim that the silver price is about to collapse. Now, it is true that silver can be an extremely volatile metal. Historically, it tends to move more aggressively than gold. When enthusiasm builds, the silver price can rise quickly, and when sentiment turns, it can also fall sharply. But volatility alone does not tell us whether a market is fundamentally weak. To understand that, we need to examine something much more important: the balance between supply and demand in the physical silver market. And this is where the story becomes far more interesting than the crash narrative suggests. According to projections from the Silver Institute, 2026 is expected to mark the 6th consecutive year in which global silver demand exceeds supply. The estimated deficit this year alone is around 67 million ounces. Now, deficits in commodity markets do not automatically lead to higher prices. Markets can draw down inventories, recycling can increase, and investment demand can fluctuate. But when deficits continue year after year, something important begins to happen. Above-ground stocks begin to decline. Now, since around 2021, the cumulative shortfall in the silver market has approached around 800 million ounces. That is close to an entire year of global mine production. In simple terms, the market has been compensating for the gap between supply and demand by gradually drawing down reserves that were built up in earlier years. You can think of it rather like a farmer consuming grain that was originally intended for planting next season. You can do it for a while, but eventually it changes the structure of the market. And that leads us to another important reality about silver that many commentators overlook. Silver's supply cannot expand quickly even when prices rise. Unlike metals such as copper or iron, most silver is not mined from deposits where silver is the primary target. In fact, around 70% of global silver production is a byproduct of mining operations focused on other metals, particularly copper, lead, and zinc. This creates an unusual dynamic. Even if the silver price doubled tomorrow, mining companies could not simply open large numbers of new silver mines overnight. Production decisions are driven primarily by the economics of the main metal being mined. So if copper demand slows, silver supply can actually slow as well. This means the silver market often adjusts through price rather than production. And that structural constraint is one reason silver has historically been capable of large price moves during certain phases of the cycle. Another reason silver markets can be difficult to interpret is that silver plays two very different roles in the global economy. It is both a monetary metal and an industrial metal. When investors worry about inflation, currency instability, or financial stress, silver can behave in a similar way to gold, attracting investment flows as a store of value. But at the same time, silver is an essential material in many industrial processes. It's widely used in electronics, electrical systems, medical equipment, renewable energy technologies, and advanced manufacturing. And more recently, another source of demand has begun to emerge: artificial intelligence infrastructure. The global expansion of AI data centers is driving enormous investment in computing systems and electrical infrastructure. These facilities require extremely efficient electrical networks and advanced cooling systems. Silver happens to be the most conductive metal known, which makes it extremely valuable in high-performance electrical applications. As a result, silver is widely used in connectors, electrical contacts, and other components that must operate with minimal resistance. For companies investing hundreds of millions and sometimes billions of dollars in new AI data centers, the cost of silver used in those systems is relatively small compared with the overall project cost. Whether silver costs $80 an ounce or $120 an ounce does not determine whether the project goes ahead. This creates a form of demand economists describe as price inelastic demand, demand that continues even when prices rise. Now, AI infrastructure is not going to consume vast quantities of silver overnight, but it does create a new layer of industrial demand that did not exist during earlier cycles. Now, of course, the silver market is not entirely without challenges. One of the most frequently discussed concerns involves the solar industry. Solar panels have historically used significant quantities of silver in their conductive paste. However, manufacturers have been steadily reducing the amount of silver required per panel through a process known as thrifting. Some companies are also experimenting with copper substitution. Now, at first glance, that might appear to threaten silver demand, but there's another side to this story. Global solar installations continue to expand rapidly as countries invest in renewable energy capacity. So while the amount of silver used in each panel is declining, the total number of panels being installed worldwide continues to rise. In many cases, the growth in solar capacity has been large enough to offset the reduction in silver intensity. In other words, solar demand may grow more slowly than before, but it's certainly not disappeared. Another major factor influencing the silver price today is the strength of the US dollar. The US dollar index, often referred to as the DXY, has recently been trading close to the 100 level. A strong dollar tends to place pressure on precious metals because commodities priced in dollars become more expensive for buyers using other currencies. Recent geopolitical tensions, including developments in the Middle East and concerns surrounding the Strait of Hormuz, have increased demand for dollar-denominated assets. That has supported the dollar and temporarily weighed on precious metals. But currency dynamics can change quickly. If interest rate expectations shift later in the year, or if capital flows begin moving away from dollar assets, the dollar's strength could fade. And historically, periods of dollar weakness have often coincided with stronger precious metal prices. Now, before continuing, I'd be actually interested in your view. Do you think the silver price is heading towards $100 again, or do you agree with those predicting a crash? Let me know in the comments below, because your perspective helps shape the discussion on this channel. Now, another useful indicator when analyzing the silver market is the gold-to-silver ratio. This measures how many ounces of silver are required to purchase 1 ounce of gold. At the moment, with gold trading close to $5,000 an ounce and silver around $80, the ratio sits at roughly 62 to 1. Over very long periods of history, the average ratio has often been close to 60 to 1. However, during strong precious metal bull markets, the ratio has often compressed towards 40 to 1. Now, if gold remained around $5,000 and the ratio moved towards 40, the implied silver price would be approximately $125 per ounce. Now, that does not mean such a move will happen immediately, but it illustrates how silver can sometimes outperform gold during later stages of precious metal cycles. Another development receiving less attention is silver's growing recognition as a strategic industrial metal. The United States has now included silver on its official critical minerals list, reflecting its importance in sectors such as electronics, renewable energy systems, and advanced manufacturing. Governments are not stockpiling silver in the same way they accumulate gold reserves, but the recognition of its strategic importance highlights the increasingly central role the metal plays in the modern industrial economy. So what does all this mean for the silver price in 2026? Well, taking these factors together, the evidence does not suggest a collapse is imminent. Instead, the silver market appears to be moving through a period of volatile consolidation. Short-term speculative positions are being unwound. Meanwhile, the longer-term structural forces, including constrained supply and persistent industrial demand, remain intact. Several price zones appear, therefore, particularly important. The first is the structural support zone, roughly between $68 and $72 per ounce. This region corresponds with longer-term technical indicators and represents a level where industrial buyers are likely to re-enter the market aggressively. Above that sits the current pivot zone, around the $80 level, where speculative selling appears to be meeting longer-term accumulation. If the macroeconomic environment becomes more favorable, particularly if the dollar weakens or interest rate expectations shift, silver could move towards a base case range between $105 and $115 later in 2026. And in more extreme scenarios involving geopolitical escalation or a speculative squeeze in the futures markets, prices could briefly reach $135 to $150. Now, such moves would likely be volatile and unstable, but they cannot be ruled out in a market as historically dynamic as silver. So the key point is this. The current environment does not resemble the conditions typically associated with a collapse. Instead, we may be witnessing a transition phase where speculative excess is being removed while the underlying market quietly tightens. Now, if you want to understand how this story develops and the deeper forces shaping commodities, currencies, and global markets, You can join us on Substack through the 2% brief, where the full strategic analysis is published and will be published further. And if you found this breakdown useful, please remember to like the video and subscribe to the channel. It helps ensure that thoughtful financial analysis continues to reach viewers who want to understand what is really happening beneath the surface of markets. And if you want to go deeper into this topic, you should watch the videos appearing on screen now, where we touch on the gold to silver ratio and what may be signalling for the next phase of the precious metals cycle. Thank you for watching. Links are below, and I look forward to seeing you again soon.